What if I told you that the billions of dollars flying around in the AI boom might not actually exist? I've worked in finance for over 15 years and I've never seen anything quite like what's happening in big tech right now. Every single week we hear about these $100 billion deals between the same few companies, OpenAI, Nvidia, Microsoft, Oracle, and everyone's acting like this is new money. But is it really just the same cash going around in circles? There's something very weird happening in big tech right now. Companies are announcing these massive, headline-grabbing deals, 100 billion here, 200 billion there, and on paper it looks like the AI economy is absolutely exploding. And the share prices of big tech companies seem to reflect that. Take a look at this graph. In the purple, we have the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And in the pink, we have the rest of the S&P 500. And you can see that the proportion that just a few stocks make up of the total market has been increasing, and with that trend accelerating even more this year. And when you look at graphs like this, it starts to make a bit more sense. The dark blue line shows it took about 13 years for the internet to hit 800 million users. ChatGPT did it in just 3. So maybe there is something to this. Maybe this is the next industrial revolution. But I think even when you look at data points like this, it doesn't quite explain what we're going to go through in this video. So here's the question I want you to think about for this whole video. Is it real economic activity? Is it real growth? Or is it just the same £10 note being passed around the table at the pub and everyone just pretending they've made £10? Because if it's the second one, that has huge implications for investors like you. And just so we're clear up front, I'm not accusing anyone of any kind of fraud. I'm explaining incentives and how they've become super weird. And when incentives get weird, markets get super stupid. But to really dive into this, let me first show you how these companies are linked, because once you see the loop, you just cannot unsee it. So undoubtedly, the best place to start is this great diagram from Bloomberg. This really shows how interconnected these companies are with one another, and I think really just exemplifies what it is we're talking about here. Now, you might understandably think this is no big deal. In a world where car parts can be assembled over multiple sites on different continents, have parts made from pretty much every country on Earth, why is this any different? And I think that's a fair assessment. But I also think that there are two differences that really set what's going on in AI apart from just about every other industry. The first is when you look at the numbers involved, we just reach a whole other level. So let's just walk through recent events to try and explain this diagram. So OpenAI announced that they would pay AMD about $100 billion for 5 million graphics cards, when AMD announced they were giving $100 billion back to OpenAI in the form of stock. Now, this is kind of an unusual start, but it's about to get a whole lot more crazy. At the same time, OpenAI also announced they'll be buying $200 billion worth of graphics cards from Nvidia. At the same time, Nvidia is going to invest $100 billion back into OpenAI. And let's just pause here for a second, because this is really where we start to run into problems. Because OpenAI was valued at its most recent funding round at $500 billion, and they've already committed to spending most of that money already. Now, the problem that Nvidia has run into is that it doesn't have $100 billion to give OpenAI. So there's another deal. OpenAI is going to give Oracle $300 billion to use their data centers over 5 years. Oracle is going to take that $300 billion from OpenAI and give that money to Nvidia to buy every single graphics card you could ever imagine to go into their data centers that they need to power their original deal with OpenAI. And finally, Nvidia is going to take the money that they've just received from Oracle and use that money to invest in OpenAI. Now, if you didn't keep up with all that, I don't blame you. But what I think it should at least do is illustrate how much each of these companies relies on one another for components, parts, processing powers, data centers, and, most importantly, cash. But I'm afraid to say there is a whole other level of complexity we've not even touched on. But the core problem that you're seeing here is this circular flow of money. Company A invests in Company B immediately spends that money back with Company A, and Company A gets to book that as revenue. Company A then uses that money to buy hardware from Company C. Company C then invests that money back into Company B. The upshot is this: everyone gets to report absolutely staggering growth, and everyone gets to say, look at how much demand there is for our totally brilliant and fantastic products, which means everyone's valuations go up. But I think we should also point out that there is a absolutely colossal marketing effort going on at the same time. Maybe AI technology really is the future, or maybe it's also simultaneously funded by people who are watching their valuations go up and up and up on the back of AI. But we should talk about how they're doing this, because the mechanism really matters. It's called vendor financing, and it should make you really nervous because it's the second reason we should all be worried about. We mentioned that there are two reasons why comparisons to things like the modern car assembly line don't really apply here. The first one we talked about is the sheer size and scale of what we're talking about. But the second one is the much more critical part, and that is vendor financing. Now, on the face of it, vendor financing can sound a bit technical, but it's actually pretty simple. It's basically when the seller helps the buyer pay for the thing the seller is selling. Sound familiar? Now, this does raise a perfectly legitimate question, which is, why would anyone do that? Two reasons. One, it creates on-paper growth. And second, it locks you in as a customer to me because we have a financing arrangement. When a company starts financing its own customers, just so those customers can buy more, it's a sign that that demand might not be entirely organic. It's like if you went to Tesco and Tesco lent you money so you could buy stuff from Tesco. But this is where the risk really goes up a level. If I lend you money so you can buy from me, I've basically taken on your risk and all other risks associated with your company and how you run it. If you blow up, I don't just lose a customer, I also lose the money which I fronted for you, which you were going to use to pay me. So the more I help you, the more you buy from me, the more financially exposed I become. And the big thing is, this is a big, undeniable risk that everyone seems to be dancing around and not really mentioning. And when I think about it, it reminds me of the 2008 financial crisis, that banks had lent to one another, slightly different because of how those deals were leveraged, but the same principle applies. And then when one of the banks started to run into liquidity issues, this had a knock-on effect on the other banks. And it's a big reason why at the start of 2007, there were 5 major US investment banks. By the end of 2008, there were only 2. The 2 left standing were Goldman Sachs and Morgan Stanley. Merrill Lynch was acquired by Bank of America, Lehman Brothers famously filed for bankruptcy, and Bear Stearns was acquired by JP Morgan Chase. Now, you might be thinking, well, how does this relate to me? And it's a fair question. But the truth is, to people investing in tech stocks through index funds, pensions, ISAs, whatever, this isn't just all a whole load of corporate flashiness. This is a potential market risk. But let's dive into why this is a risk for stocks and investors. Now, let's use this as our opportunity to link this all together. Here's the problem for investors. Stock prices are being set off the back of this explosive, off-the-charts, completely underfunded AI demand. This deadly combination, this absolutely magical cocktail of revenue growth, partnerships, and vendor financing is what's driving up valuations. But if so much of this demand really is circular, you invest in me so I can spend with you so you can invest back with me, then this starts to feel more and more like financial engineering rather than actual demand. And this starts to get even more stark when you look at a graph like this. The pink line here shows the net income, basically profit to all intents and purposes, for the top 10, not the same as the Magnificent 7, but a lot of the same players in the game. The profit for the top 10 companies in the S&P 500 are absolutely flying. The other line shows the S&P 490, basically the rest of the S&P 500 less those 10 companies. And what we can see is their profits have gone up basically nowhere since 2022. They have seen almost no growth in their profits for the last 3 years. Now, this means 2 risks for you. The first one is this kind of expectation risk. Markets are currently pricing in this enormous, this incredible, absolutely stratospheric growth. But if that growth turns out to not be real, this kind of end customer demand, then at some point those expectations have to come back down to earth. And I think that's what we're starting to see. That's what the bubble bursting really looks like. The second risk is concentration. As this graph and the graph at the start of the video shows, a lot of major stock indexes are incredibly concentrated in a handful of enormous tech giants. And this is a trend that is moving more and more in the direction of greater and greater concentration. So if you think, I'm diversified, I just own an index fund, it's totally fine, you are still basically betting your returns, your pension, your retirement on this AI boom paying off. But there is a catch, and that is where we have to start talking about the bubble logic. Now, this whole story about AI and it being the next big thing only really works from a bubble perspective if you believe two things at the same time. The first thing is that these AI companies are going to make vast quantities of money. And the second thing is that they don't care how much money they lose in the short term, because they are spending more and more now, because the more money they spend now, the faster and faster they can accelerate towards that payoff in future. So anytime you question the numbers today, you'll often get but wait until AI is really here. But this is exactly how bubbles work. Ignore profit, ignore cash flow, ignore total addressable market. Just look to the future. Just look to the time horizon that no one can specify, that no one can verify, that no one can even agree on. Just look to the future. But at the same time, we're seeing valuations just go higher and higher and higher. And the truth is, it's not all necessarily revenue. A lot of it is marketing and hype. Because it seems to me there's only two possible endings here. The first is that AI companies do eventually figure out how to meaningfully monetize AI. They can do this a couple of ways. They can use it to absolutely explode their own revenue, or they can start to roll out AI in order to cut costs, which will boost their margins. Basically, that they've been able to justify all of this short-term money burning because in the long term, it'll pay off. The second is that this infinite money glitch, this absolute funding mayhem, starts to slow down. And investors start to cotton on to the fact that what everyone was calling revenue growth and new orders and record profits was actually just our same £10 in the pub doing laps around everyone. But the problem is, if it's the second outcome, it won't just be the AI companies that get hit. It'll be anyone who decided to try and ride the AI train. So I want to go back to the question at the start of the video. Is this real revenue, or is this just the same £10 going round and round the pub and everyone thinking they've made it? And this leaves us with one inescapable question. Are we in a tech bubble? To answer that, click this video just here. If you like this video, please hit like and subscribe. Thanks very much for watching.